All right, let's dive right into this explainer. Today, we're looking at intuitive missions, ticker symbol LUNR, and asking the big question, is this space infrastructure company actually built for a long-term hold? You know, the space economy is absolutely exploding right now, and LUNR is trying to make this massive leap from a simple mission contractor to a full-blown end-to-end space platform. But let's be real, space is hard, and investing in it, that can be even harder. So, what are we really looking at here? The core tension we're going to unpack today is how to balance all that incredible hype around the lunar economy against the hard, cold financial realities. Look, it's so easy to get totally swept up in the romance of lunar landers and deep space exploration. But as focused investors, we've got to look under the hood. Here's our roadmap for today. We'll be breaking down their business analysis, management strategy, financial health, intrinsic value, technical analysis, and finally, the final verdict. Section 1, Business Analysis, the closed-loop moat. Let's get right into how this company actually operates. LUNR isn't just a basic contractor anymore. They're building this brilliant closed-loop moat across 3 distinct layers. First up, spacecraft manufacturing. Think their flight-proven Nova-C lander and the new satellite platforms from their Lantris acquisition. Second, they're building out space network services, anchored by the upcoming Altus 1 lunar relay satellite. And third, a solid ground network. By scooping up Goonhilly Earth Station and ComSat, they now have deep space communications assets across the US and the UK. They are literally controlling the whole shebang, from manufacturing all the way to deep space connectivity. And the market is definitely paying attention. Just look at this massive $1.1 billion backlog. That is an $842 million jump just from the end of 2025. It proves they are consistently winning critical contracts from NASA and the Space Development Agency. In fact, they currently hold the largest number of mission awards under NASA's CLPS program, and they just bagged a contract for 18 spacecraft platforms for missile defense infrastructure. So this isn't just theoretical pie-in-the-sky stuff. They are pulling in serious institutional dollars. But here is the absolute game changer. By controlling the foundational data and communications layer for cislunar space, they're basically forcing anyone who wants to go to the moon to go through them. To put that in perspective, they've migrated 1.8 petabytes of lunar datasets, including 2.6 million high-res images, to Texas A&M. That is a staggering 67% of NASA's total planetary data volume. And because lunar missions have to deal with a 1.3-second signal delay and have 0 GPS, this physical deep space network creates an incredibly high barrier to entry for any potential competitors. Moving on to Section 2, Management Strategy Expansion versus Dilution. Let's look at who's actually steering this ship. We've got CEO Steve Altemus, and he has a brilliant long-term vision. He's aggressively pushing for commercial mass production and moving the company away from custom, one-off aerospace engineering. I mean, they've expanded their Maryland robotics facility for the 5th time in 5 years, adding 69,000 square feet just for autonomous manufacturing alone. But, and this is a big but, this vertical integration comes at a heavy cost. To fund these strategic acquisitions, they've heavily relied on equity financing, which has ballooned their fully diluted share count to around 217 million shares. So management is walking a really tight rope here. They have to strike a precarious balance between this aggressive growth and strict capital discipline. Yes, buying Lantris, Goonhilly, and ComSat made total strategic sense to control that communications pipeline. But growth at any cost? That's dangerous. Because if they don't reel in the equity financing, current shareholders are going to keep seeing their slice of the pie shrink. Next step, Section 3, Financial Health, Revenue Boom versus Cash Burn. Let's crack open the books. Q1 2026 was a massive inflection point for LUNR. I mean, they nearly matched their entire previous year's revenue in a single quarter. Full year 2025 revenue sat at $210 million, but in just Q1 of 2026, they hit $186.7 million. A lot of that was driven by $142 million in product revenue from the Lantris acquisition. And now, they are guiding for an astonishing $900 million to $1 billion for the full year 2026. If they actually hit that midpoint of $950 million, we're talking about a true qualitative leap in scale. But here is your reality check. Negative $64.6 million. Despite adjusted EBITDA technically turning positive for the first time, heavy capital expenditures are absolutely burning through their cash. That negative free cash flow perfectly highlights the sheer cost of building out these satellite constellations and integrating those massive new acquisitions. Why does this matter to you? Well, it's pretty simple. Until those economies of scale really kick in and capital spending slows down, sustainable cash flow for investors is still a long way off. They've got $232 million in cash, which is good, but they're sitting on $336 million in long-term debt, mostly 2.5% convertible notes due in 2030. They still posted a net loss of $37 million in Q1, which is about 25 cents a share. And honestly, because of these ongoing losses, their shareholders' equity is currently negative, making return on equity a completely meaningless metric right now. Bottom line, expect free cash flow to stay under serious pressure through at least 2027. All right, Section 4, Intrinsic Value, Pricing the Future. So based on the math, how much is this stock actually worth? Well, if we run a two-stage discounted cash flow model, the intrinsic value lands somewhere between $8 and $20 per share. This highlights just how insanely sensitive this stock is to growth and margin assumptions. This model assumes they actually hit that 2026 revenue guidance midpoint of $950 million, followed by a gradual taper to a perpetual growth rate of about 2.5 to 3.5%, using a discount rate between 11 and 13%. Right now, trading around $16.40, the market is essentially pricing in a ton of optimistic expectations. They are assuming LUNR will perfectly execute their 2026 guidance, seamlessly win new contracts, and dodge any major equity dilution going forward. The margin of error here? It's practically zero. If they hit any mission failures or financing hurdles, this valuation could compress very quickly. Now, let's pivot to Section 5, Technical Analysis, Riding the Elliott Waves. Let's see what market momentum is telling us through the lens of Elliott wave theory. The technicals suggest we've completed a really deep Wave 2 pullback and might be gearing up for a massive Wave 3. If you track the price action from mid-2024 to early 2026, we saw this huge first wave advance, taking the price from about $11 all the way up to $43. That was followed by a deep retracement, our Wave 2, which brought it right back down near that $11 starting point, and that actually aligns perfectly with standard Fibonacci retracement levels. Now, if this highly subjective third wave actually takes hold, technical targets project a staggering climb all the way to $70. Wave 3 is traditionally the strongest of the impulse waves. But hold your horses, the RSI is currently sitting in neutral territory at about 44.35, so it hasn't confirmed a trend reversal just yet. And remember, wave theory is incredibly subjective. A 536% gain to $70 looks amazing on paper for sure, but it absolutely requires real fundamental catalysts to actually ignite it. Finally, Section 6, the final verdict. Is this a viable long-term investment? Let's bring all this together and give you a clear framework. There are a few upcoming milestones that are absolute must-watches. You need to keep a close eye on the Q2 earnings report, the flawless execution of the IM-3 mission, the Altist-1 relay launch, and, honestly, most importantly, the pace of their contract-to-cash conversions. These are the exact checkpoints that will tell us if LUNR can turn its highly ambitious narrative into cold, hard cash flow. As it stands, the margin of safety at the current price is pretty limited. If you're an investor seeking safe, predictable returns, LUNR remains a highly speculative play. Every single launch, every single landing carries binary failure risk. The revenue relies heavily on NASA's budget continuity, and proving out the true commercial viability of the lunar economy is just going to take more time. Look, it is an absolutely incredible end-to-end infrastructure play. If you're bullish on the space economy, this is one of the very few names out there with a true end-to-end footprint. But you have to ask yourself, do you have the risk appetite to weather the deep volatility of the lunar economy? Are the fundamental risks, the cash burn, the dilution, the massive execution hurdles, worth that astronomical upside? Or is this investment just flying a little too close to the sun? That is for you to decide.